buy this building and it costs $1 million. Okay, so it's $1 million. Well, what kind of an allocation am I going to anticipate? I am going to anticipate that probably the land is just what everybody thinks it is. It's probably going to be about 20%. And then I expect that the land improvements, you see how I'm doing this here? The land improvements I expect to be about 10%. And the contents I expect to be about 20%, which leaves the building gets the rest. That's the way cost segregation works. You look at everything else and what's left over is the building, so that would be 50%. Now, this is, don't be upset with me. You go hire somebody to do a cost segregation and it comes back that the building is 60% or 70% or 20%. It's going to be unique to your building. It's going to be unique. I am giving you an example so that you can see the relative benefits of doing a cost segregation versus not doing a cost segregation in a typical situation. All right, recently I had a client do a cost segregation on an apartment building they purchased, and I told him that we'd probably come out to about 30% between improvements and contents, and we came out to 29.6%. So I was pretty happy with that I got that close. It's not always that way, all right? It's not going to, it may not be that in your situation. But let's say that we're breaking these out, and let me just give you some numbers here. So the depreciation rate on land is 0%. The depreciation on building is going to be, in most countries, about 3% a year. Somewhere in that range, okay? Actual tables, again, are in our Fast Facts for the US. Improvements, okay, are going to be about, typically, let's say about 10% per year, and contents about 20% per year. So if I look at this $1 million, then this means I have $200,000 that is land, and that's going to have, and the depreciation is going to be 0. I'm going to have $500,000 where the depreciation is 3%, so I'm going to have $15,000 of depreciation every year on that building if my depreciation rate is 3%. On the improvements, at 10%, I'm going to have $100,000, so I should have $10,000 of improvements deduction each year. And on the contents, I have $200,000, and that means I have $40,000 of depreciation each year for the first 5 years. Of course, then I don't have any. So my total here is $65,000. Now, what if I'd not done a cost segregation and I had land at 20% and building at 80%? Well, now my land would have been 0, right? And my building would be 800,000. This is 200,000. My building would be 800,000. At 3% would be $24,000. So here's my difference, and that's a pretty significant difference right here. That the difference between 24 and 65, that's with an additional $41,000, I can go buy another building, right? With leverage, I can go buy another building. So that I can go buy a $200,000 building with that additional $40,000. So it's a big, big difference right? Even under normal circumstances, because this is normal circumstances. Now, let's say that I don't do my cost segregation until 5 years down the road. Okay, so after 5 years, let's say I've depreciated this after 5 years. So I've got 5 years of $24,000, right? So I've taken $120,000 of depreciation. What I should have taken is 5 years of $65,000. So what I should have taken is $325,000. Now, because this is a change from an incorrect to a correct, the requirements in the US are that you catch up all in 1 year. So what that means is that I took 120 and I should have taken 325. So the year I do my cost segregation, I will get an additional deduction of $205,000. Not counting my regular depreciation, I will get an additional deduction of $205,000. Remember, I'll still have the $10,000 for the improvements because this is year 6. So my contents are now fully depreciated, and I'll still have $15,000 of building. So I'll have $205,000 catch up plus $25,000, right? That's this plus this, $25,000 of regular. So my deduction that year that I do the cost segregation will be $230,000 versus what I've been taking, which is $24,000. So you'll want to review this many times. This is a course you're going to want to review over and over again. You want to go through it with your accountant, all right, your tax advisor. This is fundamentally what's going to go on in most cases, unless you have bonus depreciation. Now let's say you have bonus depreciation and you've got the same $1 million building. What do you have for depreciation your first year? Well, you still have your $15,000, don't you? Bonus depreciation allows all land improvements in the US, all land improvements and content to be expensed or fully depreciated the year you buy them, which means that you have $300,000. So with bonus, you would have $315,000 of depreciation in the first year. $315,000 in the very first year. Now, what depreciation do you have in the second year? You have $15,000. You've depreciated 100% your improvements and your content. Why would I want $15,000 in the first year? Because that is going to offset not just the cash flow from my project, it's going to create a loss for tax purposes, and it's going to offset other income like my wages or my business income or income from other real estate projects that no longer have much depreciation because we took bonus depreciation on them in an earlier year. So every year I get this $315,000. Let's say that we have a $2 million building, right? And let's say that after all expenses and after paying the mortgage and everything, let's say it produces $100,000. Let's make it better. Let's say it produces $150,000 of cash flow. Okay. Now, that's great. So I'd have $150,000 of taxable income before depreciation. Now let's say that my depreciation on this that we went through, remember, our depreciation is $625,000. So now we have positive cash flow of $150,000, but we have $625,000 of depreciation. So that means that we actually, for tax purposes, have a loss of $475,000. And we're going to put brackets. That means it's a loss, right? This is a loss for tax purposes. Well, how do I use that $475,000? I got my tax benefits against my cash flow. That I've already got my tax benefit, because that $150,000 would otherwise be taxable at my 40% rate. So I got my 40% on the $150,000 of the depreciation. How do I get my 40% on the $475,000? How do I get the rest of my depreciation? This is the rule. The rule is that this loss is going to be considered in U.S. tax law as a passive loss. That's the general rule. And passive loss can only offset passive income. Well, we've already offset our passive income. Our passive income was the cash flow from the real estate. That's our passive income. This is passive income. So we've offset $150,000. I've got $475,000. It's a passive loss. I don't have any more passive income. What am I going to do? Well, it's going to carry over. So next year, it just carries over to next year. And it carries over the year after that, and the year after that, and the year after that. So it carries over forever until you sell the property, at which point it's all freed up. Okay, it's no longer passive. The year you sell the property, you get to deduct the whole thing, whatever's still being carried over. I don't want to carry it over. I want to use it now, because I want that money now to buy the building, my next building, right? That's why I want the money. So I want to keep buying buildings. So what do? I take that passive income, that passive loss, and I go, okay, what are my choices here? My options would be, I can either take my passive activity loss and turn it into active income. I'm sorry. It wouldn't be an active income, it would be an active loss. So I can turn it into an active loss. That would be one thing that, logically, one thing that I could do to take advantage of that loss. If I could change the nature of it from passive to active, I convert the passive activity loss to an active loss. And we have two possibilities of doing that. The first is what we call real estate professional. This is not to be confused with what we normally think of as a real estate professional. This is a tax designation of real estate professional, right? It's very specific in the law, and it's really a very simple calculation. A real estate professional is someone who their activity in real estate is greater than or equal to 750 hours. Plus their real estate activity, plus their real estate activity is greater than all other business, including employment, combined. All other business combined. That's it. That's the rule. Either spouse can be a real estate professional. It does not have to be both. Either spouse. Doesn't have to be the one who earns all the money. So either spouse can be a real estate professional. If you're married, either spouse can be a real estate professional. So this is your get out of jail free card.